Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host, Tim Miller, freshly back from Portugal. Welcome back.
Yeah, great to be back, Aaron. I'm almost back in the right time zone.
Almost,
Yeah,
almost. And we'll see, because if he falls asleep halfway during this presentation, you'll know he hasn't.
that's right.
So to keep him awake, we're talking about a topic, of course, that has taken on the greatest interest, probably even in your absence, Tim, if it's fair to say as well. And that was naturally around the Division 296 changes. We did speak about this just before you left, and we did see the government announce the fact that they were revising the Division 296 rules or the better targeted superannuation concessions. We don't know whether it will be back inserted into Div 296. We're just making that
Uh,
assumption. But interestingly, we know that we have not only a $3 million threshold, but a $10 million threshold. But most importantly, we have a change in respect to dealing with unrealized capital gains and indexation. So, Tim, the most important part of today's conversation is what has happened since, because what the fact sheets provided us was a whole heap of data or detail around how they intended to apply, but it left a couple of gaping holes around how the government might look at the way in which capital gains tax will apply and ultimately whether there might be some sort of reset or not. And I might get you to now expand on what we've heard and what the Treasurer has, in essence, commented on, noting that at this stage we're still awaiting sort of formal guidance around that, which would naturally fall into consultation as well.
yeah, so look, it's interesting, and presumably, if I completely get this round the wrong way because of me reviewing it whilst travelling, then I'm sure we'll just do a re-record. Um, but my understanding of everything as it's been announced to this point, Aaron, is obviously and clearly, as we highlighted before, we're in a good well, we're in a I shouldn't say good position. We're in a different position in the sense that we're not going to be taxing unrealized capital gains, right? So,
Yeah.
so the earnings is going to be more a realistic earnings based on effectively taxable income or taxable earnings, appreciating that that's going to be your dividends, your rental incomes, and all those other sorts of elements with your plus and minuses for your pensions and your contributions and,
Contributions. Yep.
and those sorts of things. And so one of the things that's been addressed is okay, well, what do we look at with regards to capital gains tax? And we're looking at this concept of, if I'm not mistaken, of only applying Division 296 to gains realised post 1 July 2026. So effectively, there is going to be a CGT reset situation for determining what those earnings will be. And then there'll be a future point when the assets are sold where, for the purposes of this tax on the individual, okay, remembering that that's a separate issue to the fund tax liability,
Yep.
that will be looking at the growth from 1st of July to the date of sale.
Yeah, absolutely. And I think you made and raised a really important point there that we need to reinforce with this tax because, at the headline numbers, we talk about 30% and 40% tax. But in reality, we have our 15% fund tax, and that can be reduced by exempt current pension income, of course. And
Yeah,
then we have the member directed tax, which is a Division 296 directed tax on the member that
yeah,
will be an additional 15% and then potentially an additional 10% on top of that to 25 where the balances are above $10 million. So
yeah,
as you've stated there, we need to understand how the disposal of an asset will impact the fund taxation.
yeah,
And those standard principles, in essence, that we know and apply at the moment, whether something's eligible for discount, whether something is eligible for any sort of earnings tax exemption, all those things will, in essence, stay one and the same. But then what we will be ultimately looking at now is to say, well, because these are new laws, we don't want, or members shouldn't be, and the members, plural, in the fund, shouldn't be impacted by the realized result of gains or profits, unrealized profits that have been incurred or derived up until this legislation commences. So if we had something that was purchased within the fund back in 2004, why, and it hasn't yet been sold, well, why should that change in value from what it was originally to what it is at 1 July 2026 be subject to that tax? And ultimately, the Treasurer has come out and said, well, no, that won't be the case. So for Division 296 tax purposes, we will get that uplift, but it does create some challenges in terms of how we will look to deal with this, because ultimately we're going to have to factor in what that reset looks like, noting that it's not going to be used for the purposes of disposal at a fund level. But equally, when we look at the disposal for Division 296 tax purposes, we're not applying ECPI and all those sorts of things to it as well. So it
Yeah.
does become quite messy to understand, but ultimately this is what we wanted, because we only wanted to be dealing with realized gains rather than the unrealized concept. And we didn't want to have gains taxed on the pre-introduction of these measures. So ultimately, here we are.
Yeah, and before I pose a question to you, Aaron, I think you've also just raised a really interesting point. Is about the concept of the reset and not getting too confused with what we already actually have in place, which is a 2017 reset with the
Yeah.
introduction of the transfer balance cap, which is tax at the fund level. And
Yes.
so, effectively, you're going to be administering assets on into like
Yeah. Multiple
indirect
thresholds.
streams.
Yeah.
Yeah. So one for transfer balance cap purposes, where you may have already had deferred tax liabilities to carry forward, and then this reset base for determining growth from 1 July 2026 from a Div 296
Yeah,
purpose.
and the reality is all these clients were the ones that probably needed to do that CG reset in the first place, because they
Yeah,
were the ones that needed to comply back to the introduction of the transfer balance cap back in 2017.
that's right. That's right. And so therefore, we're looking at potentially a 9-year growth period for some of these investments, on what that looks like from a reset point of view. But one of the things, Aaron, obviously in dealing with this, and you said before that yes, the industry, we asked for this, or we asked conceptually for this around the actual earnings versus unrealized earnings as such. But the consideration, the real consideration, comes down to, is this a better outcome? And
Yep.
I think it's going to be different for everybody, is the obvious answer to that. But I know that you've been, in my absence, been on a bit of a roadshow with SMSF Advisor, and you've been doing I guess the technical update, the general update for everybody. But there's been a heavy focus on this Div 296 stuff, and so I think you've addressed, because you and I had some conversations while I was away. You've addressed some of this issue around the CGT and the
Yep.
realization of assets and what that might mean, not necessarily in year one or year two, but in the future years of the tax. And so maybe you can run me through a bit about that.
Yeah, so what's interesting, and you highlighted this very earlier on, is just because we end up in a situation whereby we're taxing realized gains, it doesn't mean that the result under these measures are actually better than the old methodology. Okay, so the key point to note here is when the liability arises, you should have the money to be able to pay for that liability, right?
Yeah.
Because you're actually disposing of the asset. So that is conceptually one thing that stands out from this, as opposed to the taxing of unrealized gains. Whereas if you had illiquid assets inside
Yeah.
that fund, you didn't have the cash flow to be able to support that. So the farmland and all that stuff that had been pointed out over time. But there will be scenarios, and this is where now it's the importance of modeling out what income looks like, what growth looks like, and starting to um, consider the timing of when an asset might be disposed. Because once you start to factor in what that growth rate looks like, you will end up with a fairly substantial spike in that final year of disposal, because of the fact that we need to incorporate the realized gain, so the net capital gain,
Yeah.
into the calculation, and we won't get that benefit of the exempt current pension income and that stuff as well. So it is really important to do that analysis and even contemplate what your total superannuation balance might look like leading into that stage. Because if you can reduce that overall proportion from that previous year, well, then obviously you're mitigating the exposure that you might have in the year that you actually dispose of that asset as well. So there's a bit of work to be done through that, but the landscape has certainly changed as a byproduct of the revised measures, but it doesn't necessarily mean that the quantum that you'll be paying is less because of the fact that if things still keep going up, subject to the level of tax exemption you have in your fund, subject to the level of account balance you have at that time from a TSB point of view, the result may be that you'll end up in a different position than what you would have had under the version 1 of these measures.
Yeah, and look, and I think it's a fascinating spot that we end up in. Fascinating for all sorts of reasons, not for like fantastic reasons,
Yeah.
but I think one of the things that when we looked at it from an unrealized capital gains tax point of view, we were looking just at growth, right? And so the assumption that we make is that when we look at it from an income point of view, we're looking at net capital gains,
Yeah.
and net capital gains assumes in many respects discounting, and things like that. But we don't know that, but we don't have any absolute certainty around things whether discounting will apply. That's just us applying common sense.
Yeah.
But we're dealing with the government, so these are the things that, whilst we're starting to raise it from an agenda point of view now, we want to make sure we keep our eye on it to ensure that that the tax outcomes are sort of the best they can be from the way that the calculations are done.
Yeah, and I think that just to sort of wrap this up, I think the other important thing here is what we're wanting to do, which is why we're having these discussions about I guess the intricacies that we want to understand is because the government will shortly move to consultation. And I know you were involved through the SMSF Association previously. So the more that we have these discussions, the more that questions are going to arise, which means hopefully the more that Treasury might be prepared to listen this time.
Yep.
And try and get a set of outcomes that actually work, similarly to what you got through that legacy pension conversion discussion with Treasury, which ultimately, you've been able to address most of the issues and come out with
Yep.
a palatable outcome in many respects. So, yeah, I think from that point of view, we're taking on board here the fact that we have ordinary income tax principles, or that's the sort of the terminology that's been through the fact sheet. So once you start to apply that in respect to how things relate at a fund level and then how things are attributed to earnings that get applied to a member,
Yeah,
naturally this is where we land based upon the discussion we've had today.
absolutely, absolutely. Well, I guess we look forward to the meat on the bone, as we said before.
Yeah, absolutely. And naturally, Tim, this is going to be a fairly significant part of our SMSF days as we move into next year. They won't
Yep.
be until March, but we will be heavily right in the middle of things by that point in time. Of course, they would be expected to go into Parliament probably in February if it's all resolved, and then kicking off from 1 July 2026. So, yeah, we'll be launching more about those SMSF days in December, so you can find out more then.
Terrific. Look forward to it.
Excellent. Thank you once again, mate. Good to see you.
Always a pleasure. Happy to be back on
Back
terra
on deck.
firma.
Yeah, correct. Thank you once again for joining us for this week's show. Have a great rest of the week and bye for now.
Bye.